Welcome to Sachs Realty's Tuesday Night Podcast, where we talk about anything and everything real estate. Each week, we deliver expert information enabling you to make better informed decisions while keeping more money in your pocket. If you're interested in real estate, this is your show. Hey guys, welcome to our Tuesday Night Live show. We have a really special treat for you tonight. We're actually, our guests are in studio, so always like when we do this, we get to sort of connect like we wouldn't otherwise over some type of stream. But we're talking about the markets tonight. Now, depending on who you listen to, if you follow our channel, I just had Dr. Arthur Laffer on last Saturday's video, and he talks about how debt is not a problem. We look at the debt ceiling of 35 trillion dollars. Is that good? What's happening with the dollar? How does that affect you, really, if at all? And a lot of the questions that we get here, obviously I'm a real estate broker, is should I even buy a house right now with the way that the prices are with housing and with interest rates? So I'm really happy to have Josh and Carl here from CW Advisors, and we're gonna dive in tonight. So if you have questions about what you're doing financially, what are some of the moves you should, what sectors maybe you should be thinking about investing in, or how you should be handling your portfolio, please comment them in. We'll try and advise you as much as you can, but we're not really advising you. I want to say that. But just listening to the experience of these gentlemen, and if you care to, we have just a small disclaimer that's in the show notes. It's only about 5,000 characters. Explain. But, it's the nature of what you do. I know. Yes. I'm honored. Why don't you go ahead, Josh? Kind of just explain who you are and what are the letters behind your name and what do they mean? So we'll start with you.
Sure. Josh Rivers with, as Todd mentioned, CW Advisors. Thanks for having us again. I'm a certified financial planner. For the layman, that's basically like a graduate level degree in financial planning, personal financial planning, retirement planning, those types of things. And so that's a designation that I have. And then Carl has some letters behind his name as well.
Yeah, and just staying to we have podcasting guys. We have a really interesting, since they came into the studio, we took advantage of it. And we have a show coming out on Saturday with a little bit different content. There may be some overlaps, but from getting to know you a little while earlier today, explain, you have about 200 million that you're kind of watching over, right? So
yeah,
not a little bit of money.
So I work with about 100 clients, a little over 100 clients with our firm. It's about $200 million under management. I'm doing more of the financial planning, so retirement planning, tax planning, educational planning, those types of things. Weighing in on estate, life insurance, all those types of things. Yeah. And then talk more about what Carl does, but I'm sort of the client-facing person that's doing the kind of day-to-day advice giving.
Yeah, and that's the interesting dichotomy about each one of you.
Yes.
You have totally different roles. So,
yeah.
Carl, why don't you go ahead and introduce yourself?
Sure. Yeah. First of all, thank you for having us. It's great to be here. My name is Carl Noble. I'm the Senior Vice President of Investments at CW Advisors. And in my role, my team and I, we manage the day-to-day portfolios and positioning that are for the investment strategies that our clients use. I've been at this a little over 20 years, so have experience through multiple different cycles. And then, as Josh alluded to, back in, I think it was 2007, earned my Chartered Financial Analyst degree, which is, an indication or a designation related to, investment analysis and that sort of thing. So.
And go ahead and say what you're overseeing sort of
these days
in the billions.
Yeah, our firm overall manages a little over $7 billion these days. We have an office that Josh and I work at here in Columbia, Maryland. Our headquarters is actually in Boston, so we're a national firm. We have a couple other offices around the country. My team, the strategies that we directly manage is around $3 to $3.5 billion of that $7. Most of it is, if people have heard of ETFs, we do an active ETF type of strategy where we make changes to the portfolio depending on how our views, of the economy and markets are evolving over time.
Talking about our earlier conversations, nothing like keeping you up at night when you're dealing with other people's money to the magnitude that both of you gentlemen are doing. I know what I go through when I'm helping somebody buy a house, and certainly, it may only be $400,000, $250,000, but it's everything they have. It's, they're putting all their resources to buying a house, and that lays heavy on you, when you're talking about them giving up inspection rights and, not having any money left over at the end of the day after they purchase it to make a repair. So I can't imagine the stress and going through some of these turbulent times that, really, and we're going to dive in tonight because there's a lot of headline news that I don't believe. Okay. And I think maybe a lot of people feel the same way. Yeah. We know we have an election year, and I'm not, we've talked about how there's a lot of self-fulfilled prophecy in what you guys may say that could, have major implications. But we're not going to really talk about specific companies and things like that. But we are going to talk about sectors and try and get your opinion to our audience as to, should they be concerned? We're looking at the Dow 40,000. The crazy numbers, right? The Magnificent Seven that, where we have, and we'll talk a little bit about it, where a lot of people think that these stocks are overvalued. And that if they're invested in these stocks, they could lose a lot of money, maybe all of their money. And then we have like JP Morgan comes out and says, oh, these companies are undervalued. There was just an article published in Market Watch where they say these, no. And so we'll shed some light on that. But first, and Josh, let's start with you. Tomorrow is a big day.
Yes.
Right. We're going to have pretty big news. The CPI report is going to come out in the morning. And then we have the Fed talking about monetary policy in the afternoon. What do you think is going to happen? What are we going to hear about with CPI? And what's the Fed going to do?
Well, I guess we'll really know tomorrow. I'm thinking that, no crystal ball, but thinking CPI will hopefully come in with some favorable results. What that looks like exactly, who knows, but somewhat favorable. And then we're really hoping to get direction on, an indication of, are they going to lean towards cutting rates? When? And, maybe how many? I don't think Powell's usually that direct to say exactly, but hopefully to give some hints as to, what direction they're going to go in terms of what they're going to do with rates.
The rumors are no cuts tomorrow, and September maybe for the first rate cut.
Yeah, so I don't expect them to say that they're going to cut rates tomorrow, but maybe a little timing of, hey, in the fall, and maybe one or two. I don't know if they'll be that direct, but hopefully at least some hints as to the direction they're going to go.
Yeah.
Moving forward.
A lot of people think that the Federal Reserve is influenced by political pressure. I would say it's a pretty good indication. What do you think? So you could say, well, they're not pressured politically, but some people say they didn't raise rates high enough. So do you think the Fed do you think they've done a decent job? Or do you think they should have really raised rates even higher? And what type of implications would that have had for your clients?
Have they done a decent job? My personal opinion, they should have raised rates a long time ago when things were better. But unfortunately, their hands were kind of tied with COVID and inflation. And look, they don't have that many weapons in their arsenal. That's one of them. Have they done a great job? Again, I think they should have raised rates a long time ago. That's probably about all I'd say on that.
So, but what about to the point of the investors? is what they're doing favorable to the market?
Well, let's put it this way. Last year we were looking for a pause, which we thought would be favorable to the market. We got one. It was favorable to the market. Getting rate cuts should be favorable to the market. The big thing that I think investors realize but they don't think about is what interest rate policy has done to fixed income portfolios. We work with a ton of retirees who the last 2 years are like, why is my bond portfolio negative? They don't understand the relationship to interest rates and that it's an inverse relationship. But yeah, I mean, I would think, and Carl can jump in if he disagrees, but I think we would say that rate cuts would be favorable to the equity markets.
Yeah. Carl, what would rate cuts do to inflation?
It's a good question. I think that the Fed isn't going to begin, or they claim that they're not going to begin to cut rates until they are more confident that enough progress has been made on inflation. So taking them at their word would mean it shouldn't have an impact on inflation necessarily if it's true that they are willing to wait that long. I think that's the big question, though, you alluded to. Coming into the year, the market was pricing in, I think it was almost 7 cuts back in January. Now it's down to 1 or 2 maybe. So the market got way ahead of itself because, especially in the first quarter, inflation surprised to the upside consistently for several months. So I think so far the evidence suggests that the Fed rates haven't been high enough for long enough to get inflation down closer to the 2% target that they have. Has been a lot of progress made from a couple of years ago when CPI was north of 9%, but at a little over, at around 3.5% now, it's still not quite low enough to where they want it to get to. So,
what do you think about them excluding? What do you think about CPI as a measurement of whether the health of our economy?
Yeah, it's got some flaws to it, the way that they construct the basket. And it's tough though. You're trying to create some sort of index that's representative of, how people spend their money and the prices that they're, seeing in these different ways that they spend money. So I think everyone, some of the most notable day-to-day things are, what am I paying at the gas pump or at the grocery store? Clearly those prices, or at least in the case of groceries, have gone up a lot over the last couple of years, right? So the level has gone up. That pace of the increase, and this is the interesting thing, the way, economists measure this is the rate of change, prices aren't going up as fast anymore. So, they think of inflation as cooling off, even though, again, prices aren't falling. Well, it's not disinflating, really. You're just getting slower inflation.
Yeah.
And so that's what I think.
Well, it's not deflating.
No,
we're not getting deflation, but it's disinflation.
No, you're not seeing prices fall.
When we're looking at year-over-year numbers, you
Right.
go, okay, well, that's disinflation, right? I mean, that's where it hasn't gone up that much since last year,
Right.
but it went up 9% the year before.
And I think that's where a big disconnect lies right now. When you look at measures of, for instance, consumer sentiment are pretty poor. They're very low. People don't feel like inflation is really cooling off, even though the statistics, and again, the way they measure it, do suggest that, again, a lot of progress has been made from, I think it was the summer of 2021, prices were appreciating at over 9% on a year-over-year basis. Now that's down to, a little over 3%. So again, looking at it that way suggests progress has been made, but people don't feel that prices are, coming down that they see on the shelves.
Because they're excluding things that are in the CPI report.
Right.
I mean, they're excluding food, energy.
Yep.
I mean, housing cost. I mean, housing inflation is, they about 30 to 35% of GDP if you consider all the household goods and services that go along with it, right?
Yeah, no, that's exactly right. The Fed itself likes to focus on what's called the core CPI, which, like you said, strips out food and energy. And you kind of ask yourself, well, why would they do that? Because again, those are prices that people pay a lot frequently. The reason is, I guess, the evidence or the data suggests historically that those are very noisy. So it is harder to get a true read on inflation, because those can move around a lot for other factors than underlying price pressures. So, academically and at an economist level, the Fed likes to look at that core CPI, but you're right, again, there's a little bit of a disconnect from, hey, this is what I'm paying in real life versus where you're saying inflation is, and sometimes there's a mismatch, and I think we're clearly living in one of those moments right now.
Yeah. What would have happened to the markets, to your clients, if we would have seen interest rates in double digits?
Oh, and that's an easy one. The market would have been a lot lower. I think there would have people would have seen declines in the values of the portfolios instead of what has happened over the last couple of years, where you've seen appreciation and Josh alluded to losses even in the bond market, which typically is used as kind of that safe part of your portfolio to help, as it serves as kind of a ballast to offset volatility from equities. A lot of people have some mix of a balanced type of portfolio. And just the way that, bonds did go down as interest rates even went up to where they are right now, if it went to double digits, I mean, those losses would have been significant in both parts of the portfolio. So I really think that would have been almost a worst case type of outcome if interest rates had gone that high.
Yeah.
Yeah.
Do you think they should have raised interest rates higher?
I think there's an argument that they could have gone a little higher. I don't think quite as high as, into the double digits. I don't think the evidence suggests that. But, Josh made the point earlier that we completely agree with. The Fed's issue right now is they were very late in beginning to hike interest rates. So inflation was already moving up very quickly, and yet they had kept rates at those emergency rock bottom levels for too long. So now they're scrambling to play catch up as inflation is really igniting. They did try to raise rates very rapidly, which they hadn't done in a long time. The issue now is, they've got their eye on both sides of, they have this inflation mandate, but also the labor market. And, if you keep pressing interest rates, if you keep kind of pressing on the brake with moving interest rates even higher, eventually you're going to damage the economy, which is, the other half of the mandate that they have to focus on. So I think right now they're, maybe rates aren't quite high enough, but they're also leery that, hey, if we do too much more from here, it could push us right into a recession that people thought was going to happen last year, but didn't really show up. So, that's where I think the risk lies today.
Yeah. Josh, when we talk about housing, I know you've given advice to young people on buying a house and what they should be doing. And, obviously, and the reason why I asked the interest rate question is because if you looked at the housing market since they've been raising interest rates, we haven't really seen much change. There's still a lack of inventory. And we are seeing price corrections now, but this is a major lag effect. But Carl, what you're saying is we should have raised interest rates in 2021, not 22, a year ahead of time. Because what we saw was housing inflation go up another 20, 24, 25% from 21 to 22, right? Which is a huge deal. When you're talking about homes that are $200,000, $400,000, another 20% is drastic.
Yeah.
That probably in itself really crippled our, not just the housing market, but one of the largest markets in the world. Housing's a huge market, right? Josh, do you think people should be thinking about buying a house right now?
I mean, when we talked earlier, I think everybody's situation is different. The bottom line is it's a lot harder.
How about the first-time buyer?
It's a lot harder to be a first-time buyer now than it has, been in a long time. I mean, we talked, my first home that I bought 24 years ago had an 8% interest rate, but the house was $150,000, which is totally different. And we had two incomes, and it was affordable. I still kind of believe in me personally, I believe in the American dream of buying the house. But, I think as a financial planner, we talk about lots of different financial steps, having an emergency fund, planning for retirement, and, then
take us down the road. So what comes first?
Well, I mean, so for me, you're a young person, I think, especially in these times, planning for emergency, right? Having a couple months of cash reserve. Then you're going to look at starting to fund retirement, definitely Roth as opposed to pre-tax. Don't get used to the tax deduction. And then you start looking and trying to save for a down payment for a house if that's something you want to do. But the reality is, I think the number of young people who want to buy a house is also much less than it used to be. But yeah, it's a difficult time.
Well, they can't afford it.
Well, you can't afford it, but then also don't want to be tied down. Want to be able to travel. Don't want to have to pay those expenses of maintaining the house.
Well, we're seeing the reversal of that.
Yeah.
So we're seeing first they want to buy a house because their friends are buying houses, and then they have remorse and want to get out because they didn't realize that they need to stay there for years. They moved every year in college from apartment to house to, whatever. So do you think they should buy a house with no money down?
I'm old school, I'd say no. I believe in creating equity. If you're going to do it, creating equity. So I would say no, but I also realize it's a challenge to build up that down payment.
Is it a challenge, or is it just a timing issue that maybe they should just wait?
I think it can be both. We talked about this also earlier. Like, we don't preach financial responsibility. We don't teach, finance in school. And I think saving is a hard concept for a lot of people because you have to sacrifice. And sacrifice is not really in the vocabulary in a consumeristic society. And so I think that, it's a challenge, but then also, to your point, timing. I think it's both. It can be both.
Yeah. Carl, what are you look at things, so I think it's interesting, your different positions in protecting wealth, protecting your client's money. You're kind of like a behind the scenes guy that are trying to develop the strategies. Which sector should the client be investing in? We know that you have made a lot of good decisions, good calls that no one, you were probably, let's make the decision and praying to God that it worked out, right? Is that a fair assessment?
There's some of that, for
and
sure.
some of the moves that you've made.
Right.
Part of what you do is look at everything from a geopolitical, what's happening in the market, what's happening with policies.
Yeah.
Policies play a big role in, who's going to be making the money. Who's guaranteed to get the money? Who's getting the government funding? Right? Because that's like the backing that so far has been the gold, right? Not literally gold, but a good thing. If you can get on the good graces, your product gets in, is in procurement, and they're calling for it, it's a good day, right? Or it's a defense or whatever, Department of Defense. What are your concerns from a geopolitical aspect? Do you think, is there anything that sticks out in your mind? And I know this is, this is asking for your what really keeps you up at night. Is there anything that we should be concerned with as consumers, that black swan event, that if that were to happen, we would be in big trouble with the markets?
Part of the job is constantly worrying about what can go wrong. That's a big part of, trying to prepare for risks that might erupt and that sort of thing. And to your earlier comment too, there is so much information and data out there. We like to take what we call a weight of the evidence approach, where, again, we're not tying everything to any one data point that hits, whether it's inflation or the job market or whatever. But we're trying to process, to have a more holistic view of the world, incorporating things in terms of what's going on in the economy, monetary policy with what the Fed is going to do, where things are valued, all that good stuff rolls up into one. But to get to your question, I think the world is clearly becoming a more dangerous place. We've got some pretty major conflicts going on in different parts of the world. So that does, get onto the radar screen, so to speak, a little bit. It's very hard from an investment standpoint to kind of adjust to those types of conflicts because you just don't know how long they're going to last, or actually when and where they're going to unfold and that sort of thing. So for us, we fall back on some of the core principles. Our clients are mainly very diversified across different types of investments, so that again might be kind of a boring reminder for a lot of people, but that is a core principle that I think people have to keep in mind. And then going beyond that, there are certain holdings and positions that at times we can try to utilize, especially if we think it's geopolitical risks are more heightened, whether it's something in kind of the commodity space or hard assets, if you will. Those tend to perform well, even if maybe equities are selling off a little bit because of geopolitics. So at times we might implement those sorts of strategies in the portfolios alongside of other kind of core positions that we have.
The markets, and Josh, maybe you want to pipe in on this, but how much of, when you look at the fixed income, what you had spoken about, investments, people that their retirement accounts that are tied up, and they're hoping that we don't see any kind of an event or shift that they don't have the money at retirement that they had hoped for. How much of that is reliant on the value of the dollar? The dependency of, I guess more the question would be the world's reserve currency remaining the dollar.
Carl, that might be a better question for you. But if our market is doing well and they're invested in energy sector, technology sector, healthcare sector, if the companies in those sectors are doing well, it's not necessarily something that I'm thinking about. It's really more the investment team. But yeah, I mean, the strength of the dollar is a concern. But that's more of like one of the pillars and weight of the evidence, the approaches that the investment team works on. But yeah, I mean, that's definitely something that they're thinking about and are concerned about.
So Carl, let me ask you, how dependent are the markets, the stock market, the bond market, on foreign investors?
On foreign investors, foreign investors are pretty large players in the U.S. markets because the dollar is, or has been for a long time, the reserve currency. So, even though we certainly have our warts, and getting back to Josh's point, I mean, the value of a nation's currency for us, the dollar, obviously, is largely a reflection of the fundamentals of things like the level of debt and how the economy is performing and inflation and some of those big variables. But other countries, we do have some of our issues we have to work through. Other countries have issues, in large part, are essentially worse than ours. So, the dollar may have some challenges when you consider the level of debt and that sort of thing. But, the hard part is when people say the dollar is going to collapse, it's like, well, where is that going to turn to? If you're a dollar investor, which most U.S. investors are you then going to turn to using the euro or the yen or some of these other currencies that in other parts of the world might actually have challenges that are larger than ours do? So in some ways, it's kind of a competitive game like that in terms of how the currency moves around. But the dollar is clearly very important for U.S.-based investors.
I mean, what's your opinion on the dollar?
So surprisingly, it has been pretty firm. I think the expectations were that it was going to start to weaken this year because of, again, there were those forecasts for interest rate cuts that haven't materialized yet. And what's interesting now is you're actually seeing some of the other major economies begin to lower interest rates themselves. So the ECB, the European Central Bank, just did that last week. Some other major central banks have done that recently as well. And so the dollar has actually been pretty well supported recently. And in the near term, I think that kind of makes sense to us. I think the more of the challenge lies in the medium to longer term, which that's when it's going to come back to some of those fundamentals I talked about. We really got to get our hands around the level of debt and the size of the deficits that the economy is currently, grappling with. So I think it's kind of a near term versus a medium to long term type of situation in terms of, is the dollar appropriately valued right now?
Yeah. So, any threat with the BRICS? Do you think they're going to spin out a currency here this fall?
Yeah, I mean, I think, and going back to your geopolitical question, I think clearly among the BRICS, the C, China, we've seen geopolitical tensions heighten. There are, concerns that there could be a conflict at some point, especially, you have Taiwan issue out there and that sort of thing. Hopefully it doesn't come to that. But clearly there's an element, just looking at it economically, of decoupling that's going on. For a long time, in the 2000s, there was more of a coupling with China, meaning our trade kept growing and growing. They were exporting cheap goods to us. We were buying a lot of their cheap items and that sort of thing. And that is still going on to a large degree, just because the size of the trade is very, very large. But it is kind of slowing down at the margin. And you are seeing, there are these articles about manufacturing supply chains kind of onshoring. We're trying to build, chip manufacturing plants here in the U.S. now instead of relying on them internationally and that sort of thing. So I think that's probably the biggest of the BRICS, the biggest relationship to keep an eye on. And tensions are, escalating, not de-escalating. Hopefully it just stays kind of tense and doesn't go beyond that, hopefully for all of us.
Now, I've heard that the chip plant manufacturing, or at least getting it up and running, is like a disaster. Have you heard that? I mean, I'm hearing all kinds of, reporting where they're saying it, they didn't realize how much water is needed for these chip plants and things like that, that they're way under budget for the project. I mean, are you hearing that?
Yeah, I think there have been some delays in some of the big, the major announcements that were made. And I mean, look, those are very complicated projects. Chip manufacturing is extremely specialized. Some of these specialized components are only made in a couple countries around the world, Taiwan being one of them, which is why that's so critical as part of that U.S., China, Taiwan kind of geopolitical access. Other ones are made in parts of Europe. So very complicated undertaking, and you're right, you can't just snap your fingers and have a brand new chip factory built. It takes years to get there, so it's going to take some time.
Yeah. Josh, oil. Let's talk about oil because one of the concerns that I hear people talk about is, and along the lines of the dollar or the de-dollarization or whatever, and there's big arguments to each. I interview both sides of this story. You have the Brent Johnsons of the world that with the dollar milkshake theory. I don't know if you know about that, but he believes we still have the strongest fiat currency globally. And then you hear other people like Peter Schiff that I've interviewed say, that's ridiculous. The dollar's going to collapse. There's no way. It's all unfolding, and that we need gold. I personally have a hard time. I struggle with that because I'm thinking, if there is some kind of a breakdown, I mean, what are you going to do with the gold? I mean, you're going to nip a little piece off of it and go in and buy it. But I'm not being ignorant to it because I'm still, I think that diversification is key. But I guess my question is, I think up until, and I could be wrong with my number on this, my percentage, but I'm not wrong on the first part of it, is that prior to 2023, 100% of oil trade was done using the dollar. That changed in 2023. I think maybe, do you know what the percentage of, maybe it was, I want to say it was 60%. I don't remember exactly. But does that concern you?
I mean, there's certainly some concern there. When Carl was talking about the dollar and it still being, a really strong currency, I still go back, and this isn't my saying, but the cleanest dirty shirt. I still think the petrodollar is the cleanest dirty shirt. That could happen, but I think with the BRICS, particularly the R and the C, there does seem to be more trust for them and them potentially putting up a currency that's not the petrodollar. But I don't think that they still have the trust of the global economy the way the US does. So I certainly think that could maybe happen in the future. I just don't think we're close to that, is what I would say. I don't know, Carl, what do you think?
Yeah, there are some countries, and you can think of them, they're kind of our top adversaries right now, that are clearly trying to move away from utilizing the dollar. They saw what happened with what's going on right now with Russia, where we tried to freeze some of their foreign assets that were denominated in dollars. So other countries like China are looking at that and saying, well, hey, I probably shouldn't own a lot of dollars then if that can happen somewhere down the road. So for instance, you've seen they used to own a couple $1 trillion worth of US treasuries. Now that's come down to under $1 trillion. They still own a lot, but it's come, the direction is going lower. So I think that phenomenon is out there. To Josh's, I think what he was kind of getting to is, so far it's not really at that critical mass yet that is really getting into the way the dollar is trading in terms of its value. But it's something to certainly keep a close eye on. If more and more countries start to try to do the same thing, then it could start to have a real impact, I think, over time.
Yeah. Yeah, that's crazy. When I think about, have we ever talked about this kind of thing in the history of the U.S.? I mean, were we ever looking at some of these same issues as we are today? I mean, is Russia posturing on us right now? I mean, in the news this morning, you have to search for it, but you hear about the submarine or whatever off the coast of Cuba and the warship and what? How does that? Any talk in your company about that?
Yeah, again, just the idea that the world has seemingly become a more dangerous place. For whatever reason, I'm not exactly sure, but again, some of these conflicts are erupting around the world, and some of the potential scenarios, outcomes are, quite frankly, can be frightening. If things, if somebody hits the wrong button or what have you, or things just go the wrong way. So, those are really scary scenarios. You like to think that ultimately at the end of the day, there are rational actors. China would be damaging their own economy if they decided to start a conflict with us. Because again, there are linkages, even though they're somewhat starting to decouple. So,
Well, I think China wants the land, right? They don't want to destroy the land.
Right. So you hope ultimately that cooler heads prevail and rational actors. But, again, you something you have to stay on your toes about, like I said. And there are, from an investment standpoint, which is usually the terms we're thinking of, there are, some things you can try to do, but ultimately it's hard to really, kind of game for all the different types of scenarios.
Article on Penn Wharton says that within 20 years, if we stay on the same path, that the U.S. will default on the debt. I guess looking more specifically at the bond market. What the article more specifically said was, if we don't change policy or the way that we're headed with our debt, the debt ceiling constantly being elevated and the amount of interest that we're accruing on the debt and it becoming a very large part of our taxes. When we look at our taxes that are collected, a huge part of that goes to, just like buying something at the store on a credit card that you pay 3 times the amount for because you're paying the interest. So a lot of it's going towards the back interest or the interest on the back debt. In this article with Penn Wharton, they said that if we don't change our trajectory in the next 20 years, that we'll default. The U.S. will default on the debt. Josh, what is that? Have you ever heard of such a scenario? And what would happen? Do you think that we would ever be in a situation where we'd have like a debt jubilee on the bond market, where whether the U.S. defaults on its foreign-owned bonds, investors, or domestically? Do you ever think about that?
Yeah, we think about it. The investment team particularly thinks about it. The article, I don't know that many people that would disagree with that, right? Like, if we don't have a change in policy, we can't keep kicking this can down the road. I think both sides in Washington aren't really talking about it anymore. There's a few people. There's not a lot of fiscal hawks left in D.C. But we need people who are going to be able to make some tough decisions.
What are some of those decisions?
Cutting spending, looking at our tax code, some things that will probably not be popular, but are necessary. The federal government and spending is obviously not the same as your household or my household, but you've run your household and your finances. You've been a business owner for years. You've probably had to make some tough decisions about your finances that somebody wasn't going to be happy about, to try and make sure that you could pay your debts and you could achieve your financial goals. And we're going to have to do that in DC. But right now, we're not really talking about it. We're in election season. Maybe we'll talk about it in 2025. But some hard decisions will have to be made. I'm not an economist, and I didn't stay at a Holiday Inn Express last night. But yeah, we're going to have to make some hard decisions, and we need somebody to do that. But it's a concern. And if things don't change, you kind of don't want to think about some of those scenarios.
Carl, when we're looking at bonds and we're seeing the return on, investing in the bond market and the different terms, whether it's a 2-year bond or a 10-year, can you kind of give us, how do you look at that, at what's being offered with a U.S. Treasury bond, and what does that tell you about the health of the government of the U.S. Based on what they offer with the bond market?
Yeah. So first of all, I think the last few years we've lived through a sea change in the bond market, meaning rates were at record lows because of the response to the pandemic. When the Fed first they cut interest rates to pretty much zero, and then they started doing other things beyond that. But even really going back further than that, in the wake of the great financial crisis, rates have historically been very, very low for the better part of 10 or 15 years. So a lot of seniors and other people who rely on fixed income haven't really been able to find a reasonable rate of return on safe investments for a long time. As Josh mentioned earlier, once the Fed did start to hike rates back in 2022, and now they're up a little over 5%, that was a very painful adjustment. The value of, again, I think you mentioned it, but bond prices and the level of rates move in opposite directions. So as the interest rate reset higher, current bonds that are out in the marketplace, the prices on those went down. What I think is, and this is a long-winded answer, but I'm circling around to the fact that now I think when you look at, and you can get 4 to 5% on a bond, it's a much more attractive proposition. They're not the best interest rates we've ever had, but they're the highest that we've had in a really long time. And so
Why
I do
would they
think,
be higher though on the lower term than they would be on a long term?
well, that's the other unique nature. So because the Federal Reserve controls the very shortest, the overnight rate it's called. So that's actually the higher, it's called the yield curve when you go out to those different maturities that you talked about. And the yield curve has actually been inverted for a record amount of time now, meaning the shortest interest rate is higher than the longer term rates, and that's very unusual. Normally if you lend someone money for a longer period of time, you get a higher interest rate, right? That's how it should work. But right now in this environment, it's really not. And I think the reason that those intermediate and longer term rates aren't higher is because there are these expectations that the Fed will begin to have to reduce rates again, if that makes sense. It's a little bit convoluted, but the point is that right now it's an unusual shape of, again, what's called the yield curve in terms of the shortest maturities having higher yields. That is good for people who are utilizing money markets and other very safe investments. Because like I said, they're getting a decent rate of return now compared to what they were getting for the last 10 or 15 years. But ultimately that may start to change and gradually come down if the Fed is able to begin cutting rates later this year. So.
If they were offering higher rates of return on the longer term bonds, would that negatively impact the stock market?
I think if intermediate and longer term interest rates did rise a lot from here, that would be a negative. I mean, those, when that
would be unpopular with the people that are.
It would, well, yes, it would be unpopular.
The special interest groups would not be happy about that, right?
Exactly.
People would be investing more in bonds than their companies, and they would make less money potentially.
That's true, and like you said earlier, it would just add on to what's going on in the housing market currently, where mortgage rates are the highest they've been in a long time at around 7%. So if those are based more off longer term interest rates, as you well know. So if longer term rates went up, that would only add to those problems. So higher rates on the medium to long term of the spectrum would certainly be problematic from here. My point was just that the level that they're at now, when you look prospectively, they are more attractive than they've been in a long time. And you do have more of an income cushion around that 4 to 5% range than you had previously. So you can withstand a little bit of movement around in interest rates better than you could a few years ago, as long as they don't go a lot higher from here.
Yeah, and then a layman would look at this and say, okay, well, they need money.
Right.
So they need to encourage an injection of money quickly. Yeah. So, hey, invest in a 6-month or something or whatever, and that will get us through, because they know they're not, right now, I don't think printing more money is on the table.
Right.
So they have to keep things moving, so they're encouraging investors, right? Which makes sense. If I need money, I may say, hey, look, if you lend me money today, I've got a gap, I got a stopgap here. I know I have a check coming at the end of the day, but it may be 2 months off, and hey, Carl, I need a loan, and because I need it now for 2 months, I'm willing to pay you more money. Is that a fair assessment?
I think so. Ultimately, look, having a real rate of interest, I think ultimately is a good thing for the economy. When rates are at zero, it really doesn't make sense. People can borrow money for free. That's when you gotta get a lot of misallocation of capital, a lot of distortions occur in the economy. So this adjustment has been painful because of how quickly rates did go up over the last couple of years. But ultimately, I think having a level of rates that is somewhere positive, I don't know the exact number, but somewhere around where we are seems like sort of the right kind of interest rate. And one other thing I would add that people may want to consider is that, again, the more attractive yields right now are on the very shortest stuff, as you mentioned, whether it's a money market, very short-term CD, very short-term treasury. People should think ahead a little bit if they've really piled most of their money into those types of very short-term investments, that they most likely won't stay there forever. Those will be the first ones to start to come down if the Fed does begin to reduce rates. So they may want to take some of that and go out the yield curve a little bit to try to lock in, like what I described, which are better yields that you see there. So that could be something to consider for people who have done some of that.
Let's get back to the debt for a minute, because you had mentioned something, Carl, and Josh, you can jump in on this. I mean, you had said earlier that, I mean, just a couple minutes ago, that something needs to change. A reduction of spending or something to get the debt down, right? Dr. Laffer, from my Saturday video, which is great if you guys haven't seen it, very interesting. He was an economic advisor to Ronald Reagan, and he has some very interesting things to say about debt. He was not concerned about the debt at all. $34 trillion worth of debt, hey, no big deal. I mean, that's a good thing, you know? And he made the analogy, hey, Todd, if I lend you, money at 1%, and you can make 20% on it, how much would you borrow? And I said, well, all of it, as much as I could possibly get. But when you reverse that, and let's say I lend you money at 20%, and instead of getting anything at the end of the day, you get a bill, right? And that's sort of how he described where we are now. You had said that we need to inflate this debt away. So the question, I think you had said that, right? I mean, when we were
Well, I
talking about,
didn't
you
suggest it. I just said that was one of the options that, the powers that be could consider ultimately.
we're not going to stop spending.
Right.
I don't care who's in the office.
Yeah.
We've already built this machine. It's like being in church and building a committee because you've got a problem.
Yeah.
Well, what happens is you solve the problem and you don't let the committee go.
Right.
You just create more problems to keep the committee going. Yeah. I don't think we're not gonna look at all of a sudden, I don't think we're gonna look at this, cutting budgets across the board. I don't think it's gonna happen, no matter who's in office. Now, I mean, there's arguments, look, it's above my pay grade, but what I'm saying here is let's talk about the way that we would typically get rid of debt. And Dr. Laffer said, hey, look, if you have, 10% inflation, then how much is your debt? It's 10% less than what it was prior to the inflation. So one of the ways historically that we've watched this debt bubble continue, and it is a bubble, because, I mean, it can't continue to go. I mean, Penn Wharton says we have about 20 years, and then it won't matter how many taxes we collect. It won't matter. We won't be able to collect enough tax. You'd be taxing 100%. How incentivizing would that be? That 100% of everything you made goes to tax. Yeah. That doesn't work. But how do we inflate if we go with, okay, so I look at the Fed's in a really precarious spot right now because they're going, okay, if we raise rates, we're going to crash our banks, right? And as a result, we're going to have huge unemployment. If we lower rates, we're going to have inflation. How do you have inflation coming off of what just happened since 2020 with the highest inflation that we've seen in a long time? How do you substantiate that with the fact that our job growth is probably not going to keep up? We're already, okay, we can start by saying in the housing industry, you're already 7, 8, 9, 10 times income to get it into the housing market. That's not sustainable. At a time where a healthy level would be 3 to 4 times your income. You make $100,000 combined income, you can buy a $400,000 house, or better yet, a $350,000 house. We know that's not possible, right? We know that. So now how do we expect that we're going to get out of this debt bubble and when we have not kept up with wage growth?
Yeah, it's a great question. I mean, look, once you get to this point, I think you make a great point, first of all, about the level of debt and how much we've added just in the last few years. It is an unsustainable path, so ultimately that does need to be addressed. But you're left with one of these, you're choosing between the least bad choice, right? So it's either, like Josh was saying, you cut spending that's popular. There are the current forecasts are both Social Security and Medicare are going to run out of funding in the 2030 to 2040 range. That's not far off. It's 2024 right now. That's not that far into the future. So, but the idea of cutting entitlements, not very popular, not a good way to get reelected, right? So, that's on the spending side. Raising taxes, which is another option, also not very popular. So I think politically, like that appetite is just not there, unfortunately, even though it is a major problem that does need to be addressed.
Well, you talk about cutting taxes and, going back to Dr. Laffer again, he was sort of has been associated with, and they named it the Laffer curve, even though it's not his invention, and it was somewhere between, how to come up with a taxation number or a flat tax that would encourage people to work and pay taxes. Because we know, you say raising taxes, who's going to pay that? It's going to be you and me, right? It's not going to be the wealthy. I mean, Josh, we know the strategies of a wealth advisor is how do you make your moves and avoid paying tax, or kicking that tax can down the road to where, ultimately they pass on and then there is no tax. It just goes to the heirs or whatever. But when we look at the fact that you said raising taxes, that's not going to work.
Right. It's going to be a combination of things, I think, not just any one. Yeah, if you just raise taxes, that's not going to be enough. It's going to have to be some sort of probably combinations of a policy mix, which again, the appetite just doesn't really seem to be there. I mean, I think the other part of this, though, that's important, and you alluded to, is if you're going to do some of that, cut spending, raise taxes, let's say, whatever the choice is, there should also be some way to incentivize the economy to grow faster, because that's the other important thing. There's the level of debt, and then there's also, as you well know, how much income or production are you generating to pay for the debt? Because if you can support the debt, then it may not be such a bad thing. So that would come in the form of faster economic growth. You'd like to see some policies related to that. So, and I think you well know, it could be related to incentivizing small businesses more, which are the largest hirers in the country as a group. Those sorts of things. So I
don't think they want that.
Well, right, but I'm just saying in a perfect world. It's not
going to help your market.
Right.
I mean, no offense.
In a perfect world, though, you would get faster growth.
You want less. You want. I mean, in the world that you guys play in, and I'm not criticizing you, but it's just it's ABCs. In your world, you want these big corporations to do well because that's where you're investing your clients' money, and you want them to. So when we talk about, and that's the risk.
Yeah.
And so, I have performed a lot of independent studies in small business. I've been a small business owner for 35 years. And you're right, we are the biggest employer nationwide.
Yep.
And when you take everybody collectively, the problem is that doesn't fit into the markets.
No.
Right? And that's so when we look at, and this is how I see it, and again, this is sort of like from a contrarian side, right? I look at it and I go, okay, you've got the wealthy that they care about their returns. They put their money in the stock market. They want returns on their money. I mean, if not, you're going to be in deep trouble. They're not going to like you very much, right? I'm sorry, but we're delivering losses to you. No, that's not going to work. So the system that is built right now is to keep this machine going, to keep the liquidity in the market, and which makes sense, right? And as a risk of that, the way I see it, is the risk of that is that we're going to see massive unemployment. We're going to see less small businesses in America, and because that's what's going to prove the earnings to the big businesses. I mean, is that a fair assessment?
I think you're onto something there a little bit. I mean, look, again, the medicine, if you want to call it that, is painful to take. If you're going to sufficiently address where debt and deficits are, it is going to have a trade-off. And if you raise taxes enough or cut spending enough, you're probably going to cause a recession, which, to your point, is going to lead to an increase in unemployment, and it's going to be a painful period. So, again, I think that directly speaks to why it's not politically expedient right now, and why no one really runs on that platform to potentially cause a recession, even though it is a very real problem. And a lot of politicians.
It's gonna catch up.
Well, that's what I was going to say. A lot of politicians have had the luxury of it not mattering yet, but no one can tell you the exact day and time that, we've gone too far with it. Historically, you can look at some of these relationships, and with our debt to GDP above 100% now, historically, when you look at other economies, granted smaller typically in other geographies around the world, that's been a problem area when you get above that level. And so I think now is the time that you really have to pay close attention to this and hopefully address the problem sometime soon, because the longer you wait, it's only going to get that much harder, to your point, and probably involve even more pain.
I think we've built some kind of this is our system. Josh, when you're looking at, we know that the different generations obviously, you have the silent generation that has been affected in some way or another with the Great Depression, right? Their parents. And then you have the boomers whose grandparents certainly, or maybe parents went through that. And then you have Generation Xers, right? A lot of people are mad at the boomers. We've talked about this a little bit, but I want to go beyond, because a lot of the people that are under your wealth management, I mean, they may be young, but you're managing money that wasn't theirs. Maybe there was a transfer of wealth. You know, somebody passed on and then boom, they get this money and they're like, oh, good, how do I keep it and how do I grow it? And, you know, which is great. I mean, hey, look, I'm not knocking it, right? But the question is, if we're going along with the narratives that this stock market or this financial market is such a big beast right now that we can't see, I mean, it would be a catastrophe to have a 15, 20% drop in the markets. I mean, that would be bad, right?
It wouldn't be good.
It wouldn't be good.
It wouldn't be good.
Or even more, right? Like
Yeah.
so we're really looking at protecting you call it the goose, right? The market. But yet the market, to be profitable in any kind of recessionary time, which I don't think we can avoid, is going to have to, in order to retain earnings for their shareholders, because that's important, they're going to have to cut costs as much as they can. What's the biggest cost that these companies have? What are their biggest costs?
Usually their employees, their labor. People.
Right.
Yeah.
So in your opinion, along that, and it's true, I mean, you're looking at, depending on the business, it could be 26%, it could be 42%, depending on the business, of their financial statement, could be their staff.
Yeah, labor costs.
Labor costs. What do you think is going to happen to maintain these these earnings? Because we know we're looking at lagging effect of quarter, and you know we're now well into the second quarter of 24. We're starting to see it show up. Okay, we're starting to see it show up.
Yeah, I mean, well, it's going to be layoffs, right? I mean, that's what they do. A couple of the big tech companies had layoffs. What was it, early this year, and then even in 2023. And what did they get? I mean, they got a bump in their stock price. You know, that's kind of what companies do, right? We have a recession, they've got to cut costs. They're going to lay people off.
But isn't that eventually going to catch up?
What do you mean? I mean,
it won't affect ultimately the products that they are selling?
It could. I mean, I think
unless we just
I think the argument you would get is going to be innovation, right? Like that's usually the argument is we innovate and we don't maybe need as many people. I mean, now you just kind of ask anybody a question, AI, right, is the answer, right? So whether that's the answer or not, that remains to be seen. But yeah, I mean, you have less staff. Let's just take a restaurant. You know, you look at what's happened since COVID. Most restaurants used to be open at least 5 to 6 days a week. Now, maybe 3 or 4. They have less staff. They have less staff. The service isn't as good, except for Chick-fil-A. Love Chick-fil-A. Sorry. But that's not a publicly traded company, so that's not a pitch for Chick-fil-A. But yeah, I mean, that could happen, certainly, and has in the past. That's a concern.
What do you think about AI?
I was just going to add to what Josh was saying. So you are starting to see some signs that the economy is beginning to slow down. I think last year, again, there were a lot of expectations that we were going to have a recession in 2023, and surprisingly, the economy was more resilient than people thought it would be. It withstood all those interest rate hikes, but the recent evidence this year is you're starting to see it slow down a little bit. And to your point, I mean, you've seen the unemployment rate begin to tick up. It did just hit 4% as of the latest report last Friday, which historically is a very, very low level, but it's beginning to come off of, I think it got as low as 3.4% at its very low point. So maybe it's had that inflection point where you're beginning to start to see some more slack build in the labor market. And, typically, when you see the unemployment rate start to go up, a lot of times it doesn't really just stop at a low level, it continues to go higher. So that's something I think that everyone needs to watch very closely as this year unfolds and the economy does begin to slow down a little bit from where it's been.
Yeah. Do you believe the unemployment number?
Well, I mean, I'll take it at face value, I guess, but it's that's another tough measurement. You're trying to measure something, I don't know exactly how many workers there are in our economy, 150 to 160 million, whatever the number is. And so trying to measure that every month is a tough task. And actually right now, I think getting to your point, there are some discrepancies in the data, which does, I think, raise some questions about how accurate it is. So for instance, last month, the headline number that you see in the news said that payrolls grew by 277,000 jobs, I think it was, which is great news. When you look at and that's measured through businesses and their hiring practices. There's another version of how they measure the labor market, which is surveying households and whether or not they're employed, have a full-time job, part-time job, et cetera. That actually dropped by, I think it was over 400,000 jobs in the same month. So which one is it? Was it plus 277, minus 405? And that doesn't typically happen where you can get divergences between those two on a monthly basis, but usually not to that extent and usually not to that directional magnitude. One's way up and one's way down. So to your point, I think something is going on where it begs the question of how accurate are the numbers that are coming out recently.
Yeah. Well, I know I can only go by what I see and from talking to businesses, and I think that the local businesses, they're really getting concerned. They're starting to really feel it over the last month, I would say. And as we're coming into summertime, I guess we'll really see on how tourism, reports. Let's take some questions. So we have here Charlton Zimmerman. Question for Josh or Carl. Would taking a home equity loan to invest in bonds be a good idea?
Only if the rate on the home equity loan is far below that 4 to 5% number, which it probably isn't. So the answer, I would guess, is no, because I don't think you could get a HELOC for, Josh, you probably have a better idea of where they sit right now, but the kind of general answer was if you could borrow money cheaper than you could invest that in a coupon in a bond, sure, you could do that. But I don't think that that's the scenario today. I think it's, the HELOCs are probably actually higher than that 4 to 5%.
I would agree. I mean, HELOCs, you're probably looking 7 to 8% on those, and you're not getting that on a bond. To Carl's point, you can have interest rate arbitrage. And again, if you can borrow it for less than you can invest it for, then that's not a bad idea.
Yeah.
But I've also had the experience, most banks won't let you, if a bank is asking about the HELOC and they think you're going to invest it, with their investment department, they're not going to take the money because they're worried about the liability of that. Mm-hmm. So it's kind of a risky endeavor, and generally wouldn't recommend it unless you've got that arbitrage.
Yeah. Do you know if there's any affidavits that you have to sign that says that you won't be utilizing the funds for investment?
I don't know, but when I was working at a bank as an investment advisor, we couldn't take HELOC money and invest it.
Interesting.
That was kind of a no-no.
Yeah.
So now that was like 20 years ago, but
yeah.
But another option, Todd, I know this wasn't the question, but just thinking about it a little bit more, if someone has been in the stock market, it is trading at record highs, like you said, valuations have risen to historically, they look pretty elevated depending on how you kind of slice and dice that. So if someone maybe hasn't rebalanced in a while, they've had the benefit of being in the market for the last couple of years, they've ridden that higher, that could be an idea where it might make sense to rebalance a little bit and then purchase some of a fixed income or bonds with a little bit of those proceeds. I'm not saying to sell everything and get out of the market by any means. I'm talking about if you had kind of an equity target, maybe it's risen above that a little bit, you could think about kind of trimming back that. Of course, people have to take into account their personal situations.
How old they are too.
Yeah, yes. Potential tax consequences. If it's a taxable account, you have gains. I mean, all those things need to be factored in, but that's where it could make sense, I think, is if, you take a few chips off the table, so to speak.
Yeah.
And now you can actually earn a rate of interest with much less risk.
Yeah. And besides the legal aspect, which I guess is really important to look into with, like you said, can you use HELOC funds to invest? But I've gotten a couple offers myself where they're offering an introductory rate on a HELOC for like the first 12 months, or 6 months or 9 months, odd amount of time, where you can get a really low HELOC. So maybe Charlton has gotten something like that.
Yeah, and again, it's all about the interest rate arbitrage.
Yeah, right. But the risk is, and it's no different than buying a house on an adjustable rate mortgage.
Yes.
It can bite you too, right?
Correct.
So I think, I see a lot of people forget when their CD rates, or CDs are coming up for renewal,
rolling over,
and they just roll over and they miss that window.
Yes.
Because they haven't opened their mail or what have you, and all of a sudden it went from a real appetizing rate to a not so appetizing rate, and you're like, oh man, and now you're going to give it back by cashing it in,
right,
or keeping it, in longer.
Yep.
So I know, when we're in a situation like this where everybody is kind of, depending on when you were born, you may have never experienced anything like this before, right? I mean, if you went through the 70s and 80s, you may say, oh man, when I bought my house, it was 12% or 15%, whatever. But when people are not prepared and they're going through this, I mean, everyone's looking for, what do I do with my money? Because if we let inflation deplete it away, that's not good. But then there's other sides of it, say, well, I'd rather have it liquid and take my risk and spread it out between multiple banks. So if they decide not to, they have bail-ins instead of bailouts in the bank, and they take your money over $250, per depositor. I mean,
Yep.
well, maybe I want to spread that out amongst several banks that are too big to fail, like what we hear, the JP Morgan Chases, the Bank of Americas, the big banks that have profited, tremendously over these failures through the years. But what do you do with the money? So everyone's looking for that. I mean, I get calls all the time. Should I invest in real estate? I just had somebody today. One of my, friends has an insurance company. And she said, I think I want to buy an investment property. I'm going, no, you don't. How much do you have to invest? Because if you have a couple $1 million, maybe you could take advantage of the commercial market, or access to a couple million. Maybe you can buy something for pennies on the dollar and repurpose it, which costs money. The banks aren't going to be happy to lend you money, so you're going to need cash. Right? But to buy a rental is probably not the smartest thing to do right now, because the prices are so high. Rents don't make sense. So, I can't help people when it comes to the investing in real estate. I'm hardly suggesting first-time buyers buy anything right now. Right? Just because of their appetite for risk. I mean, they think that they want it, but when they realize or get into the scenario and they can't make a repair unless they put it on a credit card, that's a problem. So yeah, we're going to dive into a little bit more specifics as the show goes on here, guys. We're going to address some more questions.
Great.
So Andrew Pillett says, just completed a rebuild due to 2017 wildfire that took out 4 buildings on my property, including the main residence. Homeowner insurance and real estate taxes are budget busters. This is just a statement there. All right, Andrew. Well, we're sorry for your wildfire loss. That's terrible. Stephen Heckler, how can we even have this debate about rates going down when they have 10 trillion that need to be rolled and issued in 2024? This is insanity to talk about rate cuts unless there is a geopolitical, event. Any comments on that?
Sure. I mean, again, going back to our discussion about inflation, I think it is a little bit of a head scratcher because, like we said, right now inflation is still too high, for the Fed's liking and relative to their sort of official target of 2%. The issue is that, monetary policy typically has long lag times. Whether they hike rates, it usually takes a while to affect the economy. This time around, they've either been diminished or even longer because, again, we talked about how the economy has withstood that. But there's the same effect on the flip side. So the Fed, rightly or wrongly, is convinced that they have rates at a restrictive level right now, which means if they leave them there for too long, ultimately they damage the economy. And on the other side of that, now they're cutting rates a lot more than they'd like to. So I think in an ideal world, the Fed would like to kind of deliver this soft landing that people are talking about, meaning the economy slows a little bit, but doesn't fall into a recession, which allows inflation to come back down basically to the target. And then ultimately they can back out some of those interest rate hikes. But we live in a world of something that's normal, that's in the, who knows exactly the right number, but maybe it's 3 to 4% instead of the current, a little over 5% number. So that's painting like the ideal picture from the Fed standpoint, that I think they're trying to thread that needle. Whether or not they're going to be successful, there aren't a lot of examples historically of soft landings. A lot of times after you get a rate hiking cycle, there is eventually a recession on the other side of that because they don't know where the right level is and they kind of cause damage eventually. But that's just kind of laying out the thought process of to the good question of, well, how can you even be considering rate cuts with how the data looks right now? I would agree with. They're trying to look down the road of, okay, where do we think it's going to be in 6 to 12 months? And ultimately, we have to start cutting rates a little before it might seem obvious. Otherwise, it might be too late. Does that make sense?
It does. So in 2007, two questions. Number one, in 2007, they dropped interest rates to 1%.
Yep.
It didn't work.
Right.
We had a massive
Yeah.
fallout. So along with that is, do you think it would work now?
Yeah.
Cutting rates. Do you think we'll be back in 2007?
I don't think we'll be back in 2007. I think the big difference this time around is, we've talked a lot about debt. The kind of where the debt sits is very different from then. So we talked a lot about, it's obvious now that it sits on the government's balance sheet. When you look at households and even large corporations or non-financial corporations, the level of debt has actually come down, at least relative to incomes or GDP, especially compared to where they were in 2007, just prior to the financial peak there, the financial crisis. Meaning that back then, consumers and businesses were very over-levered. It was obvious. And once the market turned, there was a lot of deleveraging painfully, especially in the housing market, that occurred. And ever since then, we've actually been on this path of that level of debt, again, on the consumer and business side, essentially coming down quite a bit from where it was back then. So the point being is, I don't think those same imbalances exist this time around. They're in a different place, though, like we touched on, which is a lot of that debt has ended up on the government's balance sheet instead. So what does that crisis look like someday? I mean, we can take our guesses at that, but my point is, I don't think we'll have the same replay of 07, at least on the part of consumers and businesses.
Do you think we'll have a recession?
I don't think we'll have one this year, personally. I do think
24.
24. I think there's a risk maybe in 25. And again, especially, I talked about the Fed trying to get this right. It's just a very difficult job to fine tune. I mean, I think you just alluded to the point that this interest rate is a very blunt tool that they have, and it's not perfect. And, it affects different parts of the economy very differently, as we're seeing right now. So things that are rate sensitive like housing have really taken it on the chin the last couple of years. Other service-oriented parts of the economy, or some of them are booming still because they're not rate sensitive. So, I don't think we'll have that recession this year because the service part of the economy is still doing quite well. But I think 2025 is more of a risk because the economy will slow some, and if they don't bring rates down enough, towards the end of the year, not immediately, but towards the end of the year into next year, I think they could have an issue on their hands that maybe they've overdone it.
How solvent are the banks?
So what's interesting is the large banks, and this is a difference from 2007 and 8 too, the very large banks look very strong in a lot of different ways. So if you think of the big five, the Wall Street, the big names, which is totally different from back then when they were.
Who are the big five?
So JP Morgan, Bank of America, Citigroup, Wells Fargo, those really large major money center institutions. They've gotten bigger. There was too big to fail 15 years ago. Now it's way too big to fail. But their business lines are very diversified. Their capital ratios have gone up actually in the wake. And you may know this too. I mean, they've pulled back in lending in certain areas. They've been forced to do that as a response to the financial crisis a long time ago. But the big difference this time around, and you're already starting to see these stresses, we started to see them in the spring of last year, are the more mid-sized and smaller, the regional banks. They're the ones that have large exposure to commercial real estate. They do a lot of lending into their local economies from that respect. So they have much larger percentages of those assets on their balance sheet. And as there's some big numbers getting thrown around. I think it's $1.5 trillion of commercial real estate loans have to get refinanced in the next, it's either 2 or the next 2 to 3 years, at much higher interest rates than they originally were taken out for. So some of these regional banks, and we saw a couple of them fail a year ago, are probably in for some more painful times. That's not good. The fact that it shifted from big banks last time around to smaller banks this time around. The way we look at it is I don't think it should result in it's called a systemic event that kind of is a threat to the overall financial system. And that's precisely because it's not really the biggest banks that seem to be at risk this time around. It is the smaller banks. I do think you could see maybe some more isolated bank failures in certain cases. I don't have any guesses for you as to which names those might be, but some of the regional banks that have the largest exposures, like I said, to commercial real estate specifically, they're going to have a tough time as some of these assets get revalued at much lower prices.
But a lot of these regional banks are publicly traded.
They are. So
would you say most of them are?
I actually don't know if most of them are, but there are a lot. There are quite a few. And like I said, we spend a lot of...
that's the second bite of the apple.
Yeah, sure.
Right?
Yep.
That's what they do.
Yep. Banking,
first of all, is the highest failure rate amongst businesses, right? Historically. And you don't really think of it as a failure. You think of it as like a takeover.
Yeah.
So when you look at the this bank gets bought out by that bank and by that bank, and so it's almost like a joke that you see a local branch and they're changing the name again. Right. They're changing the name again, and the people are leaving, and the people that were there today are gone tomorrow, and it's kind of they buy the bank up and they get rid of a lot of people because they just make their employees do more work. Right? It's a consolidation. But when we look at it and we go, okay, in these bank bailouts, the investors are beat.
Yeah.
They're taking the zip
to
zero,
equity
right?
Holders.
The equity holders, ones that have invested in the bank, they're wiped out.
Yeah, that's true. And look, I'll go back to, it's, in some ways it's good news that we don't believe that there's a systemic threat to the system again. The bad news, I think, is what you're talking about. When you have local and regional banks that are absorbed by the much larger banks just because they have the wherewithal to do that, you lose a lot of those ties, which you probably well know. People don't know their lender anymore.
Had it happen.
So I think that's where the problem lies. Is more
they don't care about you. You're a number.
Exactly, and especially if you're a small business and you thought you were a decent sized customer at a regional bank, now you're, like you just said, you're a nobody
they
at a huge
care
bank,
less.
right? So that's where I think more of the risk lies. Is what does this mean for the economy? Even though maybe they can avoid the pain of some more middle or smaller sized bank failures potentially, or risk to those. What does it mean for the economy, particularly in the areas where that's happening?
Yeah. When we talk about their balance sheet, like the numbers been thrown out, and I've interviewed bankers, 70% of their balance sheet is in commercial real estate. Yeah. These regional banks portfolio that stuff. So a lot of people don't realize when a bank writes a home mortgage, they sell that off to the secondary market. Boom, it's gone, right? Maybe they'll service it, maybe they won't. But commercial, these regional banks actually portfolio, meaning that they hold the paper, right? It affects them when that borrower defaults. What are your thoughts on the commercial real estate market? You're looking at this thing. What you're doing for your company and a lot of customers' money is you're looking at the REITs market, these home builders. What do you think about what's happening with the housing stocks?
Housing stocks themselves?
Yeah.
Well, it's interesting. I think you do have a big difference between REITs and commercial real estate related assets versus the home builders. We can talk about that a little bit if you want.
Yeah, sure.
It turns out I'll start with the home builders. So what's interesting is housing has been overall pretty soft, again, because of interest rates going up so much. what I think people didn't really anticipate is because everyone who refinanced at a low mortgage rate doesn't want to let that go now. There's almost no existing supply on the market, at least nationally. In different geographies, maybe it's a slightly different story, but overall, there's very little existing supply. So what did that do? That actually drove a lot of market share towards the new home builders, the publicly traded ones anyway. So their stock prices have actually done surprisingly very well the last few years. Now, maybe they've probably run up a little too far at this point. But that was an interesting development that I think a lot of people didn't anticipate, because it just looked like overall housing was in trouble, much higher rates and mortgages. But again, it was just a huge shift in market share away from, normally the new home segment of the market, I think, is only about 15 to 20%. And it's much more, existing home sales, existing homes being traded. And this time I think that market share got close to doubling. And so home builders were very active in doing that. And then I'll draw that distinction to, again, the commercial real estate. A lot of negative headlines surrounding that. I think the office space in particular, still dealing with, return to the office. A lot of places that hasn't happened to a large degree yet. These downtown office buildings in some major markets just are half empty still, if that. And so they're worth a lot less than they were before. And to your point, banks, owned a lot of this, or issued a lot of these loans and things like that, because historically commercial real estate was a great investment. And now we've run into this issue that is very specific to going through a pandemic and related to office. I will just add to that commercial real estate overall, and this, is very diverse. There's all different types, warehouses, apartments, office. There are other parts of commercial real estate that I think the fundamentals look a little better. Industrial warehousing and things like that have done pretty well. But where the concerns are and where a lot of the negative attention right now is on the office space, and the fact that, there was just an article the other day in New York City that an office, I think finally there was a fire sale price of about a third of what it sold for back in 2018. It's just, 67% haircut. I mean, that's a huge loss,
Yeah. Well, I think we have more problems in commercial than office space. I think we do.
Okay.
I think we're going to see, restaurants eating out. Number one, when costs are up, you go out to eat. It's expensive.
Yeah.
And the service is terrible for the most part, and the food isn't much better. So a lot of people are thinking, I can cook this better myself. So I think that it's restaurant specific. You can drive by on a Friday night, one restaurant's mobbed with a line out the door, and then you can see the next 4 of them are empty. Yeah. So I think we're going to see some issues with that. I think retail space.
Yeah, retail.
Look, no one's going into stores anymore. It's an effort to do so, and they don't have anything. Yeah. Part of the frustration is you go into a store, even a big box store like a Walmart even, or a Target, they have a very limited set of products that they sell. They have everything, but very limited on what you can actually buy. And so I think people are like, I'll just order it online, and I'm going to get it quickly, right? But I think I think our retail sector is not much better than the restaurant pad sites. I'm not very optimistic on any of it, honestly, because I think that as we find that this recession, and I think we're going to have, kicks in, how can we not? It would be the first time historically it's never happened, right? When you have a contraction in the money supply, this is the 5th time that's happened, right? And all 4 instances prior to now has led to some type of recession, the Great Depression being one of them. But when you look at, let's talk about the industrial sector. What we did is, for years, we didn't really build light manufacturing. We built flex space or industrial space. That means you have an office in the front, a warehouse in the back, no outside storage. So you're basically relying on a company that would ship products or deliver a product. The problem is that we know that Amazon's closed massive warehouses and distribution facilities. This is showing up. So what they overbuilt, they overcommitted, and what we saw was everybody going into the Amazon business. Well, I'll open up a warehouse and I'll ship these products for Amazon on a local level, right? How do we get the products there today, there by tomorrow with Prime and things like that? We know that they overbuilt that. So I guess what I'm coming from is a standpoint as a business owner, 35 years, and looking at what doesn't. We are so out of whack right now. None of this makes sense. So how can you? I mean, how do you think that this story ends?
I mean, look, personally, I'm always a glass half full. I'm an optimist, but you're right. There are some real challenges. To your specific example, going through the pandemic and COVID, the response to that, you're right. There was an overreaction to everyone ordering stuff when we were all shut in. All we could do was order goods online, right, and hope that they would show up. A lot of them were delayed because supply chains were broken, that sort of thing. And then there was a big shift when everything reopened, right? So we've seen spending shift from goods. Everyone, if you ordered a laptop 2 years ago, you probably don't need a new one again, right? So you'd think that companies maybe would have anticipated that, but they didn't. They overhired, overbuilt, to use your example, this warehouse space and all that. So I think, in my mind, it's more of a shift that we've seen away from goods towards services. I mean, good luck trying to get concert tickets right now. With hotels and I mean, I've been on a few flights recently. They're mostly full. So some of the service spending.
Well, they stopped flights.
Well,
they eliminated a lot of the flights, and now they're connecting, and you can't get a direct. If you want, I mean, you look at the whole flight, schedule, and they have 2 direct flights and 15 connecting flights. Yeah. You want to fly to Florida, we'll go to Detroit first. Yeah. I mean, it doesn't make sense.
No, that's a great point. But anyway, I think that's a big part of the shift that we've seen is from one thing to the other on the consumer side. But look, the consumer spending, I mean, it's not unlimited. If the labor market slows down too much, which again, it's starting to show signs to, if unemployment does tick up, that translates to less income, less spending power into the economy. So again, I hate to keep going back to it, but the Fed has the work cut out for them. I mean, there's a game of trade-offs here.
I don't think the Fed can do it.
Well, and that's what we'll have to find out.
We've come to the conclusion that it's not just the Fed.
No,
you can't just have one sledgehammer.
No.
And this is you knock down the wall, or what do you do with the sledgehammer? You need reduction of spending and a revamping of our monetary policy with federal fiscal better behavior, right? Josh, I want to come to you for a minute. And this is just sort of like a personal level stuff, and then we'll get into what do people do, how do people invest, and stuff like that. But how long? And so what we've just kind of said, and this is why I want to keep this real, because one of the things that we get amnesia. We came off such a run, and we're looking at things that just don't make sense. But we want to say, the economy's strong. Stock market's never been higher. Housing prices have never been higher. Our job market has never been higher. Our unemployment has never been lower. It's never been better, right? But we're not looking at the right metrics, right? Let's just go with the way we feel. We'll just do that for a minute, right? We go outside, and I've used this analogy a lot of times. You can listen to the weatherman regionally in your area saying that it's beautiful and 85 degrees, and you go outside and it's a hurricane. Well, you hear one thing, but you feel something different. Eventually, you say, man, am I crazy or is it a hurricane? What are they saying? It's sunny outside. Doesn't make sense. So now we see what you just said, expansion, like we've never seen it before. We've printed more money than we've ever seen before in a short amount of time. We've raised interest rates faster than we ever have before, and it didn't work. Nothing, I mean, it's like, and part of it is, I've always said there's no such thing as a recession. We're talked in them and talked out of them based on the way that we feel. But at some point we reach into our pocket and we don't have any money. Mm-hmm. So your behavior now has to match the way you feel, right? You go, I like to, but unless you're going to give it to me on buy now, pay later, which is happening, I can't have it. And my groceries are that, right? Or my way to work is that. But my question is this, Josh, what do you think we have amnesia?
Oh, we definitely have amnesia. I mean, I was talking with a colleague this morning we were talking about, you talked about the Dow when we talked about, the markets earlier, and we were talking about the S&P 500. And, almost no one remembers, and the S&P has been on an unbelievable tear. Almost no one remembers that from 2000 to 2009, the S&P made no money. Essentially, if you invested $1 the first day of 2000, at the end of 2009, you'd still have $1. I mean, there's years it was up, there's years it was down, but it was flat, right? And one of the crushing things in 2008, 2007, 2008, why people's portfolios were down so much was because they had invested a lot of money in emerging markets and international, which was actually hurt almost, more really than the U.S. stock market. So we forget the bad stuff for sure. And I do like your analogy. I mean, the economy, there are definitely some good things about the economy. There's some good things about the market. The market's been performing well.
Tell us the good things about the economy.
Well, the stock market. Stock market's done really well did well last year. It's doing pretty well this year to start. But you go to the grocery store, I mean, that's the one we talked about earlier. You go to the grocery store and you spend $300 and you're like, did we leave the other bags in the store? We got about half of what we normally get. But yeah, people definitely have amnesia, I think both good and bad. And literally one of my main jobs is to try and help people, look at things objectively, not be emotional about it, and remember what happened in the past, particularly if it's something bad. If something's bad's happening now, we'll say, hey, we got through 2008, here's how we did that. We may need to do that again. And one of your things you mentioned is a behavior change, right? So, the biggest thing that we probably talk about, or that I talk about, not Carl, Carl's really more on the investment side, is retirement planning. And people say, can I retire? Am I going to run out of money? There's kind of three things, and it's obviously this is very high level and there's more to it than this, that determine whether you're going to run out of money. How long are you going to live? We don't know that, right? But we can make some guesses on that. How much income do I have, and how much money have I saved? And then how much do I spend? The only one we can really control once you're retired is how much you spend, right? So that's part of our job. But to say that the investor or the consumer gets amnesia, I think is 100% accurate. They absolutely do.
Do you think business is overhired? You think a lot of what we're looking at with the current job market, do you think we know that the reports aren't, they revise them, but do you think we're going to see a higher unemployment here in the next 12 months?
I mean, I think there's definitely a chance of that. I mean, we've already seen, as Carl mentioned, a softening in the labor market. Have we overhired? There are definitely companies that have overhired. I think Elon Musk would tell you they overhired at X, right? They laid off 6,500 people and it's still running. So yeah, certainly places have overhired. And as a businessman, there's sort of kind of two schools of thought. Hire the people for when the growth happens, or have the growth happen and then hire the people. And there's certainly companies that have hired the people and then hope for the growth.
Yeah.
So
there's an interesting wrinkle this time too that might complicate, the outlook a little bit too, which was during the pandemic, labor was in such short supply. Businesses really couldn't find good help for whatever reason that was, that now they might be reluctant to let go of it as quickly, even if things are starting to slow down. So there is some concern that, well, wait a minute, maybe there are some layoffs on the horizon that might have already occurred, but again, businesses are reluctant to let some of their labor go because of how hard it was during the pandemic to actually find good help for a couple of years there.
Well, you look at it and you go, okay, if you don't have, and depending on what business it is, and one of the things that we talked about earlier today was what happened through the GFC in 2008, really 2012, I would say. We didn't really start seeing a rebound or growth until like 2013. But what we saw was, we're a product of being conditioned, right? We're humans and we're creatures of habit, right? So, if you become accustomed to something for long enough, it becomes the norm. And if you go back before, so each one of these major milestones in life kind of condition us to the next decade or so of the way that we behave. We know now we're so used to bad customer service. I mean, am I right? I mean, do you agree that, I mean, you just expect it, don't you? Don't you expect it?
Well, yeah, and I would say on the flip side of that is it really stands out when you get really good customer service.
Yeah, but it's so rare.
Yeah,
to the
it
point.
really stands out. Yes.
Right. So but prior to the GFC, it was expected. You had customer service, like, I mean, the cashier, the waiter, the waitress, whatever, the maitre d'. Man, you were really, now people don't care. They don't care about you. Right? So this is a very cynical thing to say, but it is a fact that we have had a disruption in customer satisfaction or service, right? So now, back in the GFC, businesses tried to hold on to the employees because they didn't want to look like they were going bankrupt. Now, they're so used to poor service, and we're so used to getting it. They're used to giving poor service now, and we're accustomed to accepting it, that it's okay if the company doesn't have the staff. You just expect it. You're going to go in a store, well, I'm just going to buy it online. You're going to go to a restaurant, well, it's going to take you you're going to drink your soda or your water, and you're going to be thirsty by the time you get another one. Or you're surprised. So where I'm going with this is, when we look at, there are certain elements of being in business. We've talked about employment as being a largest expense. And there's all kinds of things that have damaged that. The way that we've burdened employers with, cost of, having an employee, right? With the expensive medical coverage and, time off. And I'm not saying that they're not entitled to that. Look, I get it. I mean, you need to as an employer, but the regulations have made it really hard. So these businesses, big businesses, making your clients money, are going, you know what, the first thing we need to do is make sure our stockholders, shareholders are happy, so we're going to cut costs at any expense. And when I spoke to a group of restaurateurs years ago during the GFC, and I work with the Restaurant Association of Maryland, and with a business that I had started, and we were really looking at, okay, you have two different businesses. You got that mom and pop shop. They're going to do everything they can to hold on to the people. They'll put their own check in the drawer until their people are paid, because they know if they don't pay their people, they're not going to show up the next day, and a business owner will never get to cash their check. Right? It's like, they have to care about the employee a little bit more. And then you got the big businesses are like, well, let's just go down the list and see which of the unperforming stores. Let's cut this one, this one, this one, this one. Lay those people off, get rid of them. Or tell them, well, you can come to work in 5 states over if you want. We got a job for you, but you got to move. And by the way, you're only making, above minimum wage anyway, so you're not going to be able to afford to move your family. Or other words, goodbye. But that makes the shareholders happy because the earnings are maintained. That's what happens. The more we triumph the big businesses, the worse we're going to be as a society. But when we're conditioning ourselves to accept less, we're sort of like being conditioned to be programmed that it doesn't matter. We don't care about customer service, but it's going to catch us. It's going to bite us in the ass, because what's going to happen is the people are not going to make the money to keep these big businesses afloat. And we're already seeing it. We're seeing it in Walmart. We're seeing it in Target. We're seeing it in Starbucks. We're seeing all these things show up where their earnings reports aren't very good. Right? So the question is, that comes back around, is what's going to be the long-term effect of this machine that we built trying to prop up Wall Street and let our small businesses go to hell?
It's a great question, the way that you pose it. I mean, I think the term that a lot of the kind of the buzzy term that people like to use is productivity when they're talking, these large corporations on earnings calls and earnings reports, which is essentially squeezing more from less, right? We're increasing productivity. Sometimes that does mean with a less of a head count, but doing the same amount of work or more even. So you're right. A lot of these companies are focused on the bottom line, and largely because they are playing the quarterly earnings game. Wall Street says we think you're going to hit this number. They know if they don't hit the number, stock price is down 5 to 10% in a day or whatever it is. It's probably going to be a bad day.
People beat feet.
Yeah, exactly. So they're absolutely playing that game. I think ultimately the key comes back to just trying to grow the economy at large to a bigger size. But individually, you're right. These companies, I mean, that's just how the game has been created, for better or worse, particularly with publicly traded. Interesting anecdote to that, you are seeing there are a lot less publicly traded companies now than there were 20, 30 years ago, by a factor of about 3,000 or 4,000.
Consolidation.
And you're seeing a lot of, from an investment standpoint, Josh and I, in the industry, there's a lot more money being allocated to private markets. Businesses are staying private longer. They don't want to play the quarterly earnings game. There's a lot of capital from these big, private equity firms and things that are willing to lend or invest directly in private markets. It doesn't have to be a publicly traded company. So there have been some ramifications.
You can play in that arena or you can't? Is there a place for you?
It's more challenging for individual investors because it's less liquid. There are more stringent requirements, meaning a lot of times you have to have a certain level of assets before you can kind of play there. So it's largely been the playground of very large institutions, pensions funds, endowments. We have seen an evolution in the last, 3, 4, maybe 5 years that some new product is coming on the market in some of these asset classes, whether it's private commercial real estate, private credit is a big one these days, private equity even, where they're trying to make it more accessible to individual investors. And we do think that, some allocation to that makes sense, but people need to be very careful because it is less liquid. When companies don't have to report all their metrics quarterly, which private companies don't, there's a lack of transparency. And again, a lot of these investors in the space will argue that the returns are better over time, and that might be the case, but that does come with some trade-offs of, liquidity is the biggest one I mentioned. Fees can be a little higher and less transparency. So, people really need to be careful and do their homework, but it is an interesting development and something that is kind of a newer segment of people's portfolios that might complement, traditional stocks and bonds and that sort of thing.
Mm-hmm.
And it's part of being diversified.
Absolutely.
So
there's
appropriate allocation.
Well, we're seeing it happen in the housing market with fractional companies, fractional buyers, where they're spinning off and taking the investors are just putting their credit cards in, or basically sending them a fractional, buying a fractional share of a house or something like that. It's sort of like what's happening in the MLS. A lot of people are not wanting, with the multiple listing services, sort of consider that like Wall Street, where, hey, how can we beat this system? We're tired of this system. We're tired of this same horse in the race. We want to have a little bit more control ourselves over how the story ends, and we're seeing a lot of off-market deals that are taking place that never hit the MLS. And we're seeing that happen a lot with wholesalers buying houses of distressed properties with, the subject to, where people are in default in their mortgage, and they're sending them a letter or going and knocking on the door and saying, hey, look, we can help you out here. We'll pay the bank the $7,000 to $8,000 in arrears. You sign your house over to me. We continue to make your mortgage payment. So a lot of this stuff is happening where it's not hitting the MLS. So when we look at, I'm not calling you bureaucrats, but I'm going to just say, I'm going to use the term when you guys, right, are looking at this stuff and the headline news of the housing market, you have not a clue of what's really happening, and we're learning about it. I'm not putting myself in a different category because it's eye-opening for us too. We're going, geez, this stuff is happening, and we're in the industry, and we're going, man, we would have never guessed that that the investors would beat us out of this, beat this market that we're going in. So when people are like, well, there's no foreclosures, we're not seeing the inventory hit the market, it's because a lot of this stuff is not being reported.
Right.
We're subject to, if I come to you and say, hey, look, you're behind on your mortgage, I'm going to save the day, try and save your credit, and you sign your house over to me, and I'd say I'm going to pay your mortgage payment, and I catch you up so the calls stop, and you don't have a foreclosure on your credit report, as somebody that's struggling may look at that as a good deal, right? What happens? The deeds aren't recorded in a lot of cases. We don't even know the transfers happen. No due on sale clause has been triggered. The banks don't even know that it's transferred. And this is happening. So, when we look at it ourselves, we're going, look, something is going on here. It is not what you're being told.
Right.
We know that, right? You can tell me it's not raining, but when I go outside and I get soaking wet, just like I had said. Let's take a couple more questions here. They had good stuff, man. Can you believe you guys were wondering how you'd make it 2 hours and we're almost there? Isn't that crazy? All right, let's pull up a couple here. All right, here, this is a good one. Let's see. I'm not sure why we have to walk on eggshells over these things, bring the pain, layoffs, burn money, bring down inflation, and let's rebuild again. Quit it with the soft landing.
That's the Austrian School of Economics, it's called. Yeah. Let's just have the cleansing, reset. There is a case to be made. What I would say is there's never going to be the political will for that. So
no, not now.
From an economic standpoint, sometimes there is that case. Clear out the bad debt, like in the global financial crisis. Take the pain. It'll be short-lived, and we can rebound more quickly if we do that, rather than what took so long to kind of recover from that because it was extend and pretend for a long time. So I think it's a point well made. You just won't have the powers that be that are responsible for making that call ever, in my opinion, be willing to do that, because it does involve taking more pain quickly. And that's
I like that. Extend and pretend. Hadn't heard that before.
Extend and pretend.
Yeah.
Carl, we're going to give that to you, man. That's a coined phrase. Most people these days use credit. I do HVAC. The amount of people that use credit is insane. 10 to 15,000 installs are putting on the credit. Even at 0%, people are having a hard time. And look, and I want to talk to Hunter here because, as someone who has built houses, the cost of HVAC systems has gone through the freaking roof, right? I remember locally here, I was paying about $2,000 or $2,500. Hunter, you may comment on this if you're still listening, a ton for if I built a house, $2,000, $2,500 per ton installed, and that included everything, including the ductwork. Nowadays that number, I mean, it's times 5, and in some cases, I don't know that it's justified. I spoke to a roofer the other day. It's been a couple weeks, but he really pissed me off actually. Because what he said to me was, yeah, man, I'm charging so much money and I'm getting it. He's like, and then, I can't believe it. And I go out and I throw these numbers out there and I'm getting it. And a paver did the same thing. I needed some paving done on a job and I called the paver and he's like, oh, it's like, I just put these numbers on it. It's stupid numbers and the people are paying it. And I'm going, you're screwing people. That's what you're doing. You're screwing people. It's not because you can. What's the deal? I mean, why are we being a part of, hurting people in this credit economy? So when you look at it, it's not something to brag about. If I were doing it, I certainly wouldn't be happy about bragging about it.
Right.
And telling somebody, especially somebody you're giving a price to. I'm like, dude, you get lost. You're not getting my business. And I think people need to say no more. Because you want to bring it down,
Don't
say
pay.
no.
Yeah.
Be a better consumer.
Be a better consumer, say no.
Right.
I'm not going to do it. Maybe go on YouTube and learn how to do it yourself and get a couple buddies and just beat the system. And I'm not picking on Hunter here, but I'm saying is that, this environment that we have developed here will end badly. This is not going to be a good story end for a period of time, right? We're not going to take advantage of people like that and get away with it, but so long. Now what's going to happen, and we're already seeing people circle back around. There are contractors, and look, I've been a contractor for 35 years, right? And a GC, general contractor, meaning I hire subcontractors. I can't tell you the people that wouldn't take my phone call trying to get a hold of them, can't get a hold of them, that are coming back around now and saying, hey man, you have any work?
Oh, wow.
Roofer called me tonight. Hey, how do I get in with your agents? By the way, you might hate a real estate agent, but we can get contractors a lot of work if you're licensed, right? Mm-hmm. Because what are we doing? We're going in people's houses, they need it, but I'm not giving to somebody who's like, yeah, I just keep raising the price and they just keep paying it. I'm not saying people aren't entitled to a profit, because they are,
Yeah.
right? But when we're looking at taking advantage of people, it's something that, it's not going to continue. This is not going to continue.
The quaint notion of good work at a fair price,
Exactly.
And I think people should probably be careful if they are knowingly doing that, just because it might be great now, but if word gets out, then you can seriously damage a reputation, and it can have negative consequences down the road. So
I hope it does.
I would certainly be worried.
If you're
about it,
taking
but
advantage of people,
yeah. I think it was Hunter you mentioned. I would just add on. He makes a great point too. You are seeing in the broad data that credit
scared me when you said Hunter. I didn't know where we were going with this thing.
I think.
I thought. No, I'm just saying. I didn't know. I thought you were going political on me.
No.
I'm like, wait a minute.
Sorry,
You're switching gears.
I think I got
Carl.
the name right. It was the HVAC example
was
that
Hunter.
you
It
just
was
mentioned. Well, I was just going to add to he made a good point. I liked his anecdote, and you are seeing that in the broader data that credit card usage is going up a lot recently. So that, again, on the list of kind of concerns, and is the consumer starting to get tapped out? When you see that going up, you're seeing likewise credit card delinquencies starting to tick up because some people aren't able to cover that debt. And then when you look at the interest rate environment, it's gone up everywhere. But what's interesting right now is the effective mortgage rate for people that, again, have existing mortgages is very low historically. But credit card rates now are at record highs. I believe they're in the mid 20%, 23, 24, 25.
Oh man, I've seen 35.
35?
34.9%.
If you aren't paying that credit card bill off monthly, then and you're putting large purchases like an HVAC entirely on a card, and that can lead to bad outcomes eventually.
That's thievery.
Right.
Yeah.
I mean, you're charging somebody 35% on a purchase?
Yeah.
I mean, what a way to kick them in the face when they're down. And now, usually, that's not for your good borrowers, but these are for people that are struggling. So what do? We encourage the debt, we get them the finance, and then when they get down, we beat the living crap out of them so that they never get out. Right. I mean, how long does it take for them to pay for their fuel tank, their gas, right? And we were talking earlier when we were at dinner, and and along the lines of sustainability, and guys, it sounds like look, this is reality, right? I don't think any three of us sitting here are going to make a difference other than talking about the issues. And hopefully somebody's listening and saying, you know what? I need to invest. I need to slow down. I need to watch what I'm spending. I need to prepare. I need to, have a rainy day fund. I need to not overspend and, care about the way I look on Instagram with my brand new car. But getting to cars, because one of the things that we had spoken about at dinner was to fix a car. Talking about thievery.
Yeah.
You take your car into the dealer. I mean, we're talking about $5,000 to do a maintenance to your car. Right. The car was $30,000, $35,000, $40,000, $5,000 repair bill. Yeah. Come on. Seriously?
Well, you talk about reputation. Carl talked about reputation. You gouge people for long enough, it's going to damage your reputation. It's going to, you made your money, but you're not going to make any more. And the car thing is a great example, right? I know nothing about cars, but we are very fortunate. Like, I have a guy that we've been taking my car to forever. I've taken my car to him before and said, hey, I think this is wrong. And he'll examine it and come back and say, no, nothing's wrong with it. Just come pick it up. How much is that? Well, there's nothing wrong with it. I'm not charging anything. And so, do you know how many people I've sent to that guy?
That's the problem. The problem is you send everybody there and they catches on, and then you can't get your car fixed because he doesn't have time.
Yes, but
that's the problem. Well, I'm sorry, but there is something wrong with your car. But the bad news is I can't fix it for a month.
But I haven't had that problem yet.
Yeah.
And every time I'm in there, he thanks me for the business.
Yeah.
But you give good service, you're going to get more customers.
Yeah.
That's what's going to happen.
Well, look how they're building the cars. They're building the cars.
How about they're building everything?
You can't.
Washing machines, refrigerators. My parents are in their 80s. They still have like the same washer and dryer. I've been through 6 in the last 20 years.
And they don't clean your clothes.
Sometimes
with
they don't.
The water, with the limited water use, the whatever, environmentally
energy
friendly,
saver,
whatever. Don't use any water. we don't want to actually have clean clothes.
Right.
It's funny because I know what you're saying. Then you go away somewhere and they got these old clunkers and you throw your shoes in there or whatever. You're like, man, look how white these are.
Yeah.
Like I've tried to wash these things 6 times in my no water washing machine. The only thing I'm doing is getting soap scum ground in my clothes.
Right.
It's no wonder we're sitting here. We may not even smell good right now. Because of our, the way we clean our clothes, right? That's right. We know what kind of washing machine we have at home. It's like, dude, try this one. Oh man, I'll tell you, this is fun, huh? Was it true that 91 was a bad recession too? 1991.
91 was a recession, which are never good. I don't think they're, not to be glib, but it was a shorter one. So it was, the last couple of examples that I think are most recent in people's memories were very severe experiences, particularly global financial crisis. It was the worst economic collapse since the Great Depression, and it lasted for a long time. I think in 91, at least when you look at the data historically, it was a pretty short-lived recession. I can't remember if it was 3 or 4 quarters in length, but the economy recovered fairly quickly back then. Of course, they had leeway, or interest rates were higher. They had the leeway to cut them to lower rates and kind of help out, that sort of thing. So, but yeah, certainly wasn't a great experience. I believe that was the SNL, like the savings and loans. So a lot of banks failed in that example as well. But a little bit of a shorter experience when you look at just the history of recessions and how long they are and how deep they are.
Yeah. In 91, it was a really bad time for me. Contracting. I was doing work for a big home builder, they really hurt me, and they paid me 10 cents on a dollar, and they owed me a lot of money. For me, it was a lot of money, and it was a time when we were seeing people in Northern Virginia being evicted and thrown out of their houses. So it was a lot of foreclosures in that period, that early 90s period. I think it was really a spillover from the late 80s. But yeah, I felt it. It was a big impact, as a young entrepreneur. And it wasn't just the one builder. I made a living contracting with builders. They were a big client of mine, and a lot of them were just thieves. They would not pay. They wouldn't pay it, and so that was I remember as a pretty bad time. Yeah. All right, let's see here. You guys aren't going to like this one. Take your money out of the stock market and buy hard assets, or you will be sorry when you lose 90% of your investments.
It's a bold call that the market's going to go down 90.
You can always get your real estate license. You can, you want.
Yeah. No,
we'll bring you in here. You can.
So, I would say you should own some hard assets for sure. Like, we really believe in diversification. I would say, the latter principle that we would have, and disagree with me if I'm speaking out of turn, but we've kind of, at least from the strategy that Carl manages, we've always said we're going to be diversified, and we do our dead level best to not buy overvalued assets. It's gotten harder to do that, obviously, but I think owning hard assets is not a bad idea. I think only owning hard assets is a bad idea. I think you got to be diversified.
Yeah.
To not have been invested in the stock market, and there are people that got out in 2008 that never got back in. Like, you've missed out on a lot of wealth creation.
Yeah. Well, as we wind up here tonight, I want to, we've got a super chat here from Charles. Apparently MasterCard is rolling out biometrics thumbprint card in the EU, so you no longer have a card number. It creates a random token for payment. Yeah, we appreciate you, Charles. That's we know there's going to be some real freaky stuff coming down the pike. It's something completely off topic, but well, we'll save that.
I'm not in
for another
favor
day.
of that, by the way.
Yeah, we'll save that for that. Anyway, guys, we thank you for listening tonight. By the way, these are great guys here, great advisors. They work very hard for their clients. Josh and I podcasted probably a year and a half ago.
Yep.
And it was great value to our audience. We're in uncharted territory. I don't think anybody can say that we've been in a time like this, at least living. where things look so good on the outside, and we're kind of wondering like how long can it last. But let's kind of end with some tips. And obviously, I mean, you guys, you can't help everybody that's out there, but if somebody, just give a scenario. Josh, you had done it earlier, and would kind of give each one of you an opportunity. You're advising your kids for the first time on, they get a job, they're emerging into the market. We hope that there's a bright future. We believe that it will be. We think that we're resilient, right? We're not going to, I don't think we're going to see an end of the United States of America. Very patriotic. I love the country, despite how unhappy I am with the position that we're in with our economy, or the way that, and not just talking about this administration. Look, I've been in business for 35 years. I think that when the government shows up, it doesn't matter which side they're on. It seems like we're always hitting a gnat with a sledgehammer. And I think as a result of that, we are to where we are a lot today. But the fact of the matter is that we will come out of whatever we go through, unless we're, in some kind of a nuclear war, which we hope not, right? Where, everything is over as life as we know it. And I would certainly hope that would never happen. But give us some, we'll start with you, Josh, talking to the people that are starting out, trying to, make a way. What should they be doing besides saving money? But give them some ideas, percentages, what do you recommend? How much do they save? What should be their pecking order?
Yeah, I mean, I think the first thing I would say is, most people spend more time planning what they're going to do on the weekend and their vacation than they do about their finances. Like they don't really think about it, right? So I think whether you work with me or another financial planner, there's a ton of resources, even on the internet that are free. You got to come up with a plan. But I think, a couple things are going back to the credit card thing, right? Try not to use a credit card. You want to understand debt. Other than, maybe buying a house and a couple other things, debt's not necessarily a good thing to have. So having an emergency fund, starting to save for retirement, through your employer. Hopefully you have an employer plan. Most people do. There's some people that don't. But starting that, you're always going to
Should they max it out?
Well, if they can afford to, yeah. But I would always say, at the very minimum, if you have an employer match, do enough to get that. It's free money. Why would you give away free money, right? I think the Roth is a great option for people. Hopefully that'll stay around.
I think it might not.
It's a great financial planning tool. It's tax-free. We can thank Peter Thiel, I think, for, there's a little bit of a possible attack on Roths. Secure Act 2.0, some of the stuff that they wanted to do with Roths didn't happen. But get a Roth while you can, and hopefully they stay around. And have goals and make a plan for those goals. But again, most people spend more time planning a vacation than they do planning their finances. And I think you have to take time and
they say yourself. We'll do it later.
Yeah.
You're young, I don't have to worry about it yet. I'm 40 years from retirement, and then all of a sudden...
It happens faster than you think.
Yeah.
It happens a lot faster than you think.
Yeah.
But I think, starting to have an emergency fund, starting to save for retirement, and then looking at, we talked about buying a home, right? Got to put money down. Your next goal is putting money down for a house. But have goals and have a plan to meet those goals.
Yeah. Great advice. How about you, Carl?
I think from an investment standpoint, the biggest thing, and it sounds very simple, but I think it's tough for a lot of people in real time to do, is stick to a plan or a process or a portfolio that has been appropriately put together. Maybe you did it on your own. A lot of people, there's a lot of information on the internet. Maybe people have assembled a portfolio that makes a lot of sense to them. Maybe they're working with a financial planner like Josh. But whatever they've come up with, try to stick to that. And it's very hard to do sometimes, especially when markets get volatile. But particularly young folks who are just entering the workforce, being accepting more risk, because over time you're going to, where you end up, you're going to, earning those longer term returns that compound over time is going to, you're going to end up in in a good spot, even though there will be some rough years along the way and some rough periods. Folks who are closer to the end of their career or in retirement, it's a different story. And you got, again, it comes down to some of the variables Josh talked about, but trying to determine the appropriate amount of risk and then kind of sticking to that. There's a whole a segment of finance that you wouldn't expect probably, but that's focused on behavioral finance, essentially psychology.
Yes.
And it's because we're all human. I mean, we work with some really successful professionals in their fields, people that have done very well being doctors, lawyers, educators, engineers, whatever it may be. They're still human, and so when the markets get volatile or when certain news hits the headlines, they're subject to the same sort of emotions that anyone fears. Like, hey, am I about to lose a lot of money? Should I make a big change? What should I do? Should I get out now and wait until everything feels good and get back in? We don't recommend trying to market time like that. It's very difficult to do. You have the first decision is really easy, to press the sell button. The second one in terms of when to get back in is always hard because when you should get back in, it doesn't feel good, meaning the market's lower. But that's when people should get back in. A lot of times they wait till it's gone back up a lot because they think the coast is cleared, but now you're kind of buying back in at a higher price. So point being is you want to, as much as possible, try not to jerk around your portfolio too much. Occasionally rebalancing, like we talked about earlier, if you think you should have a certain mix of stocks and bonds, and maybe the last few years with the stock market at record highs, those have appreciated a lot. Maybe you bring that in a little and kind of rebalance, it's called. But overall, I think sticking to a plan is going to serve people the best. And again, in a conversation that's like, well, that's easy to do. In real time, our experience working directly with clients is a much different story. It can be very hard to do.
And just to add to that point, I think most people are very visual. The charts and graphs, it relates well. So JP Morgan has a monthly thing they put out called their Guide to the Markets. Some of it is really deep dive, nerdy economic stuff, and it's probably not that interesting. And some of it is just really good practical stuff. They have a chart, and I want to say it was over the last 20 years, and they looked at the S&P 500, and I think you might know these numbers a little better than I do, but the S&P averaged about 9.2% over the last 20 years. If you were to be out the 10 best days over a 20-year period of time, your return was cut almost in half. You go out another 20, you go out another 10 days, so now you're out the best 20 days, it gets cut in half again. You're not staying invested, and one of the reasons why is because the best days and the worst days tend to be very tightly clumped together. So there's a value in having this plan, this investment plan, and staying invested. Now you can rebalance, but the behavioral finance of it, everybody knows buy low, sell high, and most people do the opposite.
Yeah, well, that's the game. That's what they're banking on.
Yeah.
I mean, that's what they're banking on. I mean, look, the casinos never lose.
Right. They don't. And again, I think a huge part of my job, and really more than Carl's, because I'm the one meeting with the clients, is
getting them off the cliff.
Getting them off the cliff and the amnesia and reminding them.
Yep.
You mentioned a little while ago about a 15% drawdown in the market. Did you know since 1980, the average intra-year drop in the market's like 14%? People don't know that. They don't remember that. So that's a huge part of it is behavioral finance and trying to help people not make bad decisions.
What you're describing too, and what you're saying is stay put.
Now, for the most part, yes.
So with clarification, if you're with a good wealth manager,
yes,
where they can move you around to where your money is working in the market, right? It's when you take the money, it's when you're not well advised and you take your money out of being in the markets, right? And circulating and where you can make, and that's the benefit of you guys, right? That's the benefit of not doing it yourself,
right?
Because you don't know. And you're not in it as a group, so you're not, what you guys do is amazing. But go ahead.
I was just going to add to that, Todd. With the market at record highs, this is the perfect time really for people to kind of reassess, am I taking the right amount of risk? If the market goes down by 20 or 30% and no one knows if that's going to happen tomorrow, 6 months from now, 2 years from now, whatever.
Lights off.
Right. can I withstand that, whatever that dollar decline is on my portfolio, or is that going to be too painful? If so, then now's the time to begin to maybe bring that back at all-time highs, right? You don't want to wait until you're forced to make a decision in a bad market environment. The market's already fallen a lot. Now you're uncomfortable, or now you're losing too much money, and now you're forced to make a bad decision at a bad time. So this really is the time to kind of make that assessment of your personal situation. And if it, you know, if it is a good time to sell a little bit maybe, or do some of the rebalancing we talked about, then great. You know, again, you're doing it at all-time high prices.
I think the same thing with the housing market. So I talk to sellers a lot, and you'll appreciate this, but they're saying, you know, I want to sell within the next 3 years. Let's just say that's a scenario, right? Or in the next 18 months. And I'm looking at them going, geez, we're at all-time high. You know, if I had to predict, if we see a dip, it's going to be in that time period. Yeah. So I don't have a crystal ball, but a lot of sellers are holding on, and they may end up waking up saying, man, I should have sold this house a year ago when I was thinking about it, right? So, and there are a lot of reasons why people are holding on to that money, right? That one is their low interest rate. You know, they're making their decision based on their interest rate, not on their market price, and potentially at this point being at the highest that they may see in the next several years. So I think, you know, if they're going to stay in the game, they're going to plan on staying in the house, then it's not even a conversation to have, because it doesn't matter. It's like, even if you overpaid for your house in the last couple of years, if you're planning on staying there 10 years, it doesn't matter as long as you can afford to make the payment. Where you're going to lose is if you sell it in the dip. Right? And it's no different than the stock market. So what we're trying to do is the same thing you are. We're trying to advise and either talk them off that cliff or encourage them to act on something that they should be acting on if it's a period of time. But anyway, guys, we thank you so much for staying with us in this Tuesday night. If you guys are looking to buy, sell, or rent, or if you're a landlord and you're looking for tenants, and you're in Maryland, I hope you call me. I'm your guy. If you're anywhere else, we have an amazing broker network all over the country. Go to SachsRealty.com. I know it's kind of late to plug that, but this show is brought to you by Sachs Realty, so we have to get that in. But anyway, guys, thank you so much.
Thanks for having us, Todd. Appreciate it.
Thanks, Todd.
Appreciate it. See you next time.
All right.
Thanks.
Okay.
Bye-bye.